Today, we're looking at Warren Buffett's forgotten partner, Rick Guerin. You're all probably familiar with the relationship between Warren and Charlie Munger, but in the early days, there was a third partner, and his involvement with Warren and Charlie was critical to their later successes at Berkshire Hathaway. In fact, his involvement added tens of billions of dollars in value to Berkshire Hathaway. So, who was Rick Guerin, and why has he been largely forgotten? Born in Los Angeles at the onset of the Great Depression in 1929 as John Patrick Guerin, and simply known as Rick, the third partner of the Berkshire Hathaway trio was just as smart as Warren and Charlie, but he had a far less stable upbringing. He came from a working-class background, and his mother, employed as a seamstress, died from alcohol abuse when Rick was a teenager. In the same way that Rick shared an intellectual affinity with Warren and Charlie, he also had their work ethic. Starting at just 6 years old, Rick would sell and deliver ice to homes in his neighborhood, a critical service in the hot Los Angeles summers before home refrigeration became universal. From this, he graduated to selling newspapers and building his delivery round in South Los Angeles. At much the same time, Warren was doing the same know-how. Rick graduated from Loyola High School at 16 and immediately joined the Navy, lying about his age so he could be admitted and fight for his country toward the end of the Second World War. Rick's intelligence was quickly identified by his superiors in the Navy. Finishing the entry intelligence test with time to spare and scoring an off-the-charts score according to Charlie, he was assigned code-breaking duties while stationed in the South Pacific. However, and as we see throughout his life, Rick was something of an adrenaline junkie, and sitting in an office deciphering codes all day didn't provide him the rush he required. So quite obviously, he traded a career in the Navy for the Air Force and trained as a fighter pilot. Because he joined the military at the end of 1944, Rick saw no action and was relatively quickly demoted back to civilian life. Back in Los Angeles, he worked jobs in construction, as ski patrol, and as a model to save money, but was never able to save enough to fulfill his dream of attending medical school. Instead of a career in medicine, Rick studied mathematics at UCLA and immediately accepted a job at IBM as a computer salesman. Again, similar to Warren and Charlie in the early years, Rick had a big desire to get rich. Very, very rich. In addition to the day job at IBM, Rick started looking into money management. Initially, this was to enable him to intelligently invest his own capital. But, as we know with Warren and Charlie, it came to engulf Rick and became his full-time career. In the late 1950s, Rick started to professionalize his investment activities, spurred by a career change to a stockbroker, which included buying a seat on the Pacific Coast Stock Exchange for himself. Rick later explained that in the 1960s, there was a fixed commission system for buying and selling securities, which created a not insignificant drag on profits. The only way to beat the commission was to become a member of the stock exchange, at which point the commission was entirely eliminated. This is exactly what Guerin did, which not only helped to reduce costs and boost his trading profits, but it also brought him into the sphere of other professional investors, with whom he could discuss investment ideas and exchange share tips. In 1961, Charlie Munger, still working as a lawyer in Los Angeles, teamed up with Jack Wheeler to establish a trading firm on the Pacific Stock Exchange. As a part of this new business partnership, Wheeler was trying to sell the remainder of his old partnership, Wheeler, Cruttenden and Company. The buyer of this business was Rick Guerin, who, by his own admission, quickly realized upon meeting Charlie Munger that he was on the wrong side of the deal. Rick was smart enough to release that he wanted to be going where Munger was heading instead of buying the business he was shedding. His instinct proved correct, and Rick ultimately lost the $40,000 he paid for the residue of the Wheeler partnership. That equates to more than $400,000 in 2025, and was a very painful early loss for the young Guerin. Despite the setback, Guerin took every advantage of his introduction to the young Charlie Munger to form a new friendship, and he used both Munger and Wheeler as mentors to teach him all that about investing and the law which he didn't yet know. One significant change from this transaction, other than the loss of $40,000, was that Munger encouraged Rick to form his own partnership, in the same was Buffett had already gone to work and encouraged Munger to do the same. And so J.P. Guerin and Company was established. Beginning operations in 1965, Guerin and Company, subsequently Pacific Partners, went on to have an absolutely stellar track record. In his famous essay, The Super Investors of Graham and Doddsville, Warren Buffett provided the track record Guerin achieved at Pacific Partners, and it was quite spectacular. As we can see in the table, Rick absolutely destroyed the S&P 500 index, delivering a compound gain of 22,000% for the fund compared to just 316.4% for the S&P 500. Warren lauded the achievements of Rick, and it's understandable why. In the same essay, Warren compared the returns of 7 investors in his group who were all investing according to the same value approach, and as we see in this table, Rick came second in annual returns, with only Buffett himself beating his record, and even then, only by 0.2% per year. It's also interesting to see, out of all the super investors, it was Buffett's most famous partner, Charlie Munger, who was the laggard. But how exactly did Rick, an individual with no schooling in investing or economics, manage to trounce the benchmarks so comprehensively? One part is intellectual power. The second was using the Ben Graham method of value investing, which was particularly beneficial at a time when so many companies were selling below their economic worth. And the third was his apparently limitless energy in seeking out opportunities, finding deals missed by Warren and Charlie. Rick, much like Buffett, was an avid reader of newspapers. Once, when scouring the Los Angeles Times, Rick spotted an estate sale for a doctor who was the controlling investor in K&W Products, a tiny chemicals company which made a product that sealed leaks in car radiators. The inventor of the product used to drive to commercial garages, drill a hole in his engine, and then seal it using his product. Sales started to come in thick and fast, and the company grew to a fair size. This growth involved the inventor selling shares, including a controlling block to the doctor named in the estate sale. It transpired that this doctor had borrowed $80,000 from 2 of his wife's aunts, invested in the company, and promptly died. Bizarrely, the doctor had made his mistress executor of his will, and the situation became somewhat messy. Rick found this deal and proposed he and Munger buy $180,000, note each at face value, and then exchange the notes for equity in the company. This resulted in Rick and Charlie becoming controlling shareholders of K&W Products, with the management owning the remainder of the shares outstanding. In less than 2 years, with operational efficiencies wrung out, Rick and Charlie's $160,000 combined investment was revalued to $600,000. And shortly thereafter, the company was absorbed into Berkshire Hathaway. Shortly after this coup, Rick struck again when from reading his local newspaper, he learnt about Blue Chip Stumps, a company that would ultimately define the early years of Berkshire Hathaway. At the time, Blue Chip Stumps was bogged down in a lawsuit where small retailers were suing the company for anti-competitive business practices. These mom-and-pop stores wanted the opportunity to participate in the ownership of Blue Chip Stumps in the same way the large retailers who founded the company did. A judge ruled that Blue Chip Stumps had to open the company to these smaller retailers and sell 1/3 of the company to third-party investors. And so, its shares began to trade over the counter. Blue Chip Stumps was a trading stamp company, many of which were popular in the 1960s and 1970s. When people shopped at certain stores, they would be rewarded with stamps, which were collected and pasted into books, and when a customer had collected enough, they could be exchanged for gifts such as homewares. The beauty of these trading stamp businesses was that retailers paid for the stamps ahead of time, and the company only had to pay out to the customers when they had collected enough stamps. This business model provided a steady stream of capital which could be invested, much like the float generated by insurance companies, and in which Warren was already interested. Rick once again took this investment idea to Charlie. However, this time, due to the larger size of the opportunity, Charlie took Rick and the proposal to Warren in Omaha. Warren immediately saw the value in Blue Chip Stumps, and in particular, in the float generated which he knew could be invested more intelligently than it was currently. And so, In the early 1970s, Rick, Charlie, and Warren began accumulating shares in blue chip stamps. Over the next few years, the group slowly assumed complete control of blue chip stamps. Rick, through his own account and via Pacific Partners, acquired under 10% of the company. Munger, though his partnership, acquired another 8%. And Buffett, with the greatest resources of the trio, became majority shareholder. He bought 13% in his own name. Berkshire Hathaway, of which Warren owned 36%, Bo another 17%, and Diversified Retailing, of which Buffett owned 42%, acquired a further 16% of blue chip. All told, Rick, Munger, Buffett, and their various investment vehicles acquired more than 75% of blue chip stamps, of which 60% was owned directly by Berkshire Hathaway. The investment was a huge success, but possibly not in the way most people might expect. You see, blue chip stamps had sales in excess of $124 million when the trio began to acquire the company in the early 1970s. However, by 1982 sales had collapsed to just $9 million a year, a reduction of 93% within a decade. The success came from what Rick, Charlie, and Warren did with the float generated by the company. They used this free cash to acquire other companies. In particular, they bought See's Candies, Wesco Financial, the Buffalo Evening News, and Precision Seal, all of which became hugely valuable and delivered rivers of cash which Buffett, through Berkshire, could invest and compound into the behemoth we see today. Never one to rest on his laurels, Rick continued looking for opportunities, and in 1972 he again partnered with Charlie to purchase a closed-end investment fund called the Fund of Letters. The fund had got into financial trouble after a period of poor management. Rick and Charlie set about changing everything about the fund, including the name, which was quickly changed to the New America Fund. The two sold off poorly performing assets and reinvested the capital in the types of deals they favored, which included the Daily Journal and Capital Cities, which later became a Berkshire Hathaway investment. During their tenure, the net asset value per share of the fund increased from $9.28 in 1974 to $29.28 in 1979, a compound gain of 26%. This was one of the last deals in which the trio were partners. Warren had effectively taken control of Berkshire Hathaway in 1965 via the Buffett partnership. However, he continued investing through the partnership until 1969, when it was liquidated. Thereafter, Warren was the chief executive of Berkshire Hathaway, and this was his sole investment vehicle. As part of this rationalization, other holdings such as blue chip stamps and diversified retail were merged into Berkshire in exchange for shares. At this point in time, Rick ended up with a 1.4% holding in Berkshire, slightly behind Charlie, who had 1.5%. The thing is, as we mentioned earlier, Rick was something of an adrenaline junkie, always seeking out new investment opportunities. He wasn't the sort of person to sit in an office in Omaha reading hundreds of company reports each month. The track record of Pacific Partners, whilst impressive over the long run, was also volatile in the short term, sometimes wildly so, with annual drawbacks in excess of 40%. This pattern continued throughout Rick's career. He was sometimes wildly successful, but other times he found himself short of capital and had no alternative but to sell down his Berkshire stock. It was Rick's willing use of leverage, his flirtation with Hollywood, and his other investment activities that resulted in his eventual exit from the Berkshire share register, and also prevented him from becoming a billionaire like his more famous two partners. Warren Buffett explained in later years, "Charlie and I always knew that we would become incredibly wealthy. But we were not in a hurry to get wealthy. We knew it would happen. Rick was just as smart as us. But he was in a hurry. And so actually what happened was that in the 1973 to 74 downturn, Rick was levered with margin loans. And the stock market went down almost 70% in those 2 years. And so he got margin calls, and he sold his Berkshire stock to me. I bought Rick's Berkshire stock under $40 apiece, and so Rick was forced to sell shares at $40 apiece because he was levered. If Rick had kept hold of those shares until today, you would have been worth almost $15 billion. However, despite these missteps, Rick was still exceptionally wealthy and lived a very full life, continuing to invest and to fly aeroplanes into his later years, rubbing shoulders with Hollywood A-listers, and having 7 children. Rick died on the 13th of October 2020 at age 90 years. I think the moral of this story is, be hungry, work hard, make the right contacts, but only ever use debt sparingly. Well, that's all I have for you today. Thank you for watching, and I hope you'll join me next time for more of the same.